Good morning and a warm welcome to our monthly house view. The United States is now the main source of geopolitical uncertainty for investors. In their eyes, the latest business and consumer surveys published for February confirm the growing risk of stagflation. On the one hand, already high inflation is set to rise further as tariffs are implemented against a growing number of trading partners. The forthcoming extension of the trade war to Europe is the most recent example. On the other hand, the Trump administration is currently focusing its efforts on two policies on its agenda with the most negative impact on economic growth: trade policy and immigration. The increased risk to growth can also be seen in the bond markets, where yields on 10-year US sovereign bonds have fallen by over 50 basis points since their highs for the year. Although some activity data are undeniably weaker than anticipated, we still expect economic growth in the US to be above its equilibrium level in 2025, albeit below that posted in 2024. This is in line with our reflation scenario. The latest survey reflects, above all, the uncertainty generated by the start of the new Republican administration, as well as a phase of readjustment following the strength in private consumption at the end of the year in anticipation of higher tariffs. Faced with these uncertainties, we remain invested in equity markets, but in January already, we decided to diversify our allocation by reducing our exposure to the US market. We upgraded our view on Europe and Asia. For China, while the macroeconomic environment remains challenging, the launch of Chinese companies into the global AI race has generated a great deal of enthusiasm in markets. We have also reallocated part of our liquidity to hedge funds, giving us participation in rising markets while limiting downside risks. Finally, we are still positive on the US dollar and gold in face of rising trade war risk. Thank you for tuning in, and I hope to see you next time.